Welcome. We are back live in the studio, and today we have Austin Reed, one of my favorite lenders. Austin is from Revolution Mortgage. Austin, welcome. So glad to have your smiling face in our studio on this sunny day. Let's get to it.
Sounds good. Super
right.
happy to be here. Thanks for having me in. This is awesome.
Yeah, we're excited. So we haven't had a lender on, and I think in this market it's good to kind of get down to the brass tacks of that, because when a lot of our clients look there, they always seem to be more interested in who's going to give me the best rate.
Yes.
And, they listen to us, but it's always good to have that education before you go out and you start looking at those rates, because there are a lot of other factors that are included in how you want to look for a loan officer.
Mm-hmm.
And I'd love for you to talk about that. Talk about your philosophy and how you got into the business.
Mm-hmm.
And then I'd love how your company is set up. And I'd love for us maybe to finish up with talking about the way your company is structured and why it's important to somebody who's looking to finance.
For sure.
Super.
All right. So we'll start with the interest rate question, because that's kind of where everybody always wants to start. So I think that what's really important to understand about interest rates is, at a very basic level, based on the way that the United States economy works, the interest rates are pretty much all set based off of the secondary market, which is things like mortgage-backed securities, the bond market, because in the United States, oddly enough, all of these things are being kind of bundled as a product, and they're being sold inevitably to end consumers, like whether they're individual investors, you get a lot of hedge funds that invest in them, insurance companies, things like that, to kind of build out their portfolio. Those are the places that are making the money off of the interest rate in the end. And they're built into these big pools of securities so that ultimately, if a couple fall out, it's not the end of the world.
Right.
So because of that fact, what's really ironic is everybody goes out shopping aggressively for interest rates, but the interest rates are almost always going to be almost exactly the same across the board. It's very difficult to find a lender that is giving you something that is not kind of, the standard for the market, because the market is what's setting those. And if people are giving you an interest rate that's significantly higher than the market, it's not really going to have a place in a security. And same thing with interest rates that are significantly lower than the market. Now, obviously, this all comes back to economics. Lenders are making money off of the loans that they create and that they originate and that they sell or bundle or service. And there's a whole other world about that we'll save for another time. But the long and short of it is, similar to any sort of business out there, there is a rate that is basically being dictated by the market on any given day. And you're probably going to have people that are charging a higher interest rate for whatever reason. You're also probably going to have people that are trying to give a slightly lower interest rate. And generally what we see in that is, when you are looking at interest rates and you get very, very aggressive in terms of your rate shopping, because there is essentially a rate that is set by the market, and then there is a discounted rate, the people that are providing a discounted rate are almost always providing discounted service. And so I think what happens is, a lot of people think, well, the lowest interest rate out there should be the baseline, and everybody that's charging a higher interest rate, those people are overcharging for the market. Whereas really the middle of the pack is kind of the regular interest rate that you should be getting. And if you're going with somebody that is higher, it's generally because maybe there's more risk associated with your loan. Your credit score is really bad, or something else that causes them to offset that risk with a higher interest rate. Or the people that are charging a lower interest rate are basically, have a very bare bones structure. They don't have the technology that the people that are kind of middle market are, and they don't have the level of service that the people that are kind of charging like the going rate is. I think you could probably liken that to, in some sense, maybe to real estate commissions as well, in that generally speaking, they're pretty much set across the market. You get some people that charge higher, and you get some people that charge lower.
Right. And
there are some companies out there that are notorious for charging lower, and there's a level of service that kind of comes along with that.
Right. And a level of surprises that usually comes along with that.
Yes, very, very true. Not the nice kind.
No, not the good kind. Not the good presents at closing.
Right.
Yeah. Great. So there's a lot of misconception as to, they're charging the higher rate because they're making a profit off of that.
Correct.
Talk to our viewers a little bit about how that isn't the case, and that the lender, him or herself, is not profiting on that interest rate.
Right. So back before the housing market completely collapsed, this was one of the things that was a big problem. Is if a loan officer or a lender was able to sell a higher interest rate, they could in essence make more money off of that higher rate that they were selling. Now, obviously, that was probably one of the largest red flags when everything collapsed, because it's a massive conflict of interest, right? You have a client and you are essentially directly trying to, charge them a higher interest rate over a long period of time. So when lenders get paid out and when loan officers get paid out, their commission structure and their fee is essentially set. They have to set that fee, and they don't have carte blanche to just kind of go all over the place and charge you a higher rate. It's not like the sort of thing where, a loan officer can offer an interest rate and you can say, well, I don't really like that one. And they can say, well, give me 1 second. Let me call my manager, and then put the phone on hold and be like, okay, we'll just give you the lower rate. So everything there is set. It's extremely highly regulated. We have a lot of governing bodies that are, kind of watching lending and lending's every move these days. So there is a lot of that is going on and is being watched over to make sure that the consumer is getting the best possible, deal and the best possible transaction for them, and that they're being protected and there's no predatory lending practices or anything like that going on.
Great.
Yeah.
What about paying down with points? A lot of people will ask that, can I get a lower rate if I pay down the points, and why does it matter? If they're all getting paid the same, how come I have to pay more and I can get a lower rate?
Yeah, for sure. This is definitely something I talk about probably on every single call with clients, because a lot of people will come in and they'll send screenshots.
And by the way, Austin's calls with clients are so detailed. It's fantastic. Makes our job very easy.
Well, thanks, Lisa. We try and give them the full transparency. That's really our team's whole philosophy is we provide transparency in everything and the education, because on the one hand, these are massive financial decisions, especially here in the city. Like the average loan sizes are very, very, very high because places are so expensive. But at the same time, it is ultimately one of those things where that's how we kind of differentiate ourselves and set ourselves apart from everybody else and have clients continue to come back, which is whenever anybody has a question, we give them the full transparent answer, because sooner or later, if they look hard enough, they're going to be able to figure it out. And I'd say it's just easier for them to hear it directly from us right up front.
Yeah.
But with regard to the points thing, that's something that a lot of people are always asking about. And the way it usually comes up is people say, oh, well, you're saying you're at, 3% today, for instance. Well, I've got a lender that's at 2.5. And again, going back to what I was alluding to earlier, that delta between those interest rates is too high for there not to be something weird going on, because there has to be, because if the market is basically providing a rate of 3% for everybody and someone's giving away 2.5%, they have to be charging points or origination points or discount points, however you kind of want to refer to that, in terms of buying that interest rate down. Points at a very basic level are really just kind of simple arithmetic. It's basically an upfront cost that you spend in order to buy your interest rate down in the long term. So if you spend, call it, $1,000 on points, and that $1,000 saves you $10 per month because your rate is lower, then you just do the division. That's 100 months. So, call it about 8 years, 8 1/3 years or so before paying those points actually pays off for you. And so a lot of times what happens is people come in and they're asking for the lowest interest rate. And I kind of force them to take a step back and say, look, I know you're saying that you want the lowest interest rate, but what you really mean is you want to save the most money over the life of your loan. And those two things, if everything else was exactly the same, the lowest interest rate over 30 years, yeah, that's going to save you the most money. But when you look at the example that I just gave, some people are like, well, I really want the lowest rate. And I would say, well, you're buying your first home. It's a studio apartment in Boston. It's quite expensive, but you're in your 20s. Do you really think in another 8 years, you're going to still be not only living here, but still have the same mortgage?
People always forget about that. You're not in, so many times you're not in your home long enough to make those numbers actually be beneficial.
Yeah. And you and I were talking about it before the show.
Yeah.
I mean, I've been in 3 different condos, all within the South End, because I'm obsessed with the South End, but
it's a good place to be obsessed with.
Yeah, it's not bad. Right. But I've been in 3 different condos in the South End, and that's been over, I think it's only been about 7 or 8 years now since we'll call it 8 or 9, because I don't remember if I count 2020 as a year in my brain anymore. But each place that I've been in, I've really only been in for somewhere between 2 and 3 years. And I've been very fortunate to be able to keep those loans. But I've refinanced them multiple times, to take advantage of lower interest rates, restructure my portfolio. And so honestly, what I usually do when I get a mortgage, whether it's a refi or sometimes even on a purchase, is, and this might be getting a little bit too far into mortgage stuff. You can stop me if I'm geeking out.
But that's why we have you here. We love the geek aspect.
Yeah. But so in the same way that if you are spending money to buy your interest rate down, you can do the opposite as well, which is you can take a slightly higher interest rate and you can receive a credit from your lender back at your closing. Because again, going back to the regulatory aspect of things, once a lender makes what they're set to make on a loan, they can't make more and more and more money. So if the rate is 3% today, maybe it costs you $2,000 to get down to 2.875, but maybe the lender gives you a credit of $2,000 if you take 3.125 instead, which is really kind of where things like the no closing cost refi come from. In terms of, again, you're taking a rate that's higher than what the market gives you, but the market rate, or the quote unquote market rate that most people think of, is the one where you're paying closing costs. And so I just had a call with a client before here where I said, look, you can spend $2,500 or $3,000 on costs to refinance and you can drop your rate by a full point, or you can spend zero money to refinance, because we'll give you, instead of going down a point, you'll go down 3/4 of a point. You'll still save $300 a month instead of $330 a month. And you will literally be doing this for free, because the lender makes extra yield on your loan and they have to pass that through to you as a closing cost credit. So everything gets paid for, which is one of those things that, quite frankly, like every time I say it, I know everybody gets this. Well, that's too good to be true. Like $300 a month for free for 30 years. And you have to remember that, again, that all comes to fruition due to external factors like the environment, the economy, and stuff like that. It's not like you missed out on something when you got your first loan. It's just that the world is different now,
That's right. And lending had to change.
Right. Exactly. Yeah.
So talk to people a little about what they can expect in regard to closing costs, what's included in them, and how they can determine them.
Yeah.
And as a ballpark, obviously you have to talk to your lender to understand the different fees that each company has. But if you could give them just an overall kind of bird's eye view of what they should expect.
For sure. So it's hard. I'll say the one thing that a lot of, not a lot of, the entire internet will tell you is they'll give you a percentage of your purchase price or your loan size that your closing costs will be. It's really hard to use that figure because most closing fees are actually a set number. And so when websites come up with that fee, or that percentage, I should say, they're basing it off of like the national average for a loan size or a home price, which, if any of our viewers here are local to Boston, know that we are not in the average for, the national like home prices. Boston, New York, Miami, San Francisco, like a lot of these markets are significantly higher. So what that means is a lot of people come to me saying, well, I'm buying a $750,000 condo and I'm budgeting like 5% for my closing costs. But 5% only works if you're talking about like a $200,000 loan or a $250,000 loan. The percentages are actually going to be much lower when you're looking at a higher loan amount or a higher purchase price. So from a closing cost standpoint, obviously talk to your lender. But generally you're going to see some sort of a flat fee from your lender. They have to pay processing, they have to pay underwriting. We have a lot of technology that we have to pay for. And we have a lot of staff. We try and shield everybody from how hard it is to get a loan closed, and make it seem as easy as possible. But there's a lot of stuff going on behind the scenes that we have to be able to obviously pay for. That's usually these days somewhere between like $1,300 and $1,500. I've seen fees that are a lot higher. I've also seen fees that are a lot lower, but then those fees are generally made up for in points, or you're dealing with an online lender who says it'll take 120 days to close your loan, which is a different problem altogether. Yeah. But you'll generally see a flat fee there. You'll have a couple.
We don't recommend online lenders. Can I say that 3 times?
You sure can.
Yeah.
And also online lenders do not mean lenders that have a website. It means people that are just online, and we've all seen it. It's a problem. Yeah. Hopefully we'll get to the point someday where it's very, very easy to snap your fingers and process a mortgage, but we're not there yet. But we'll talk about that, I think, a little bit later here. But you'll have a flat fee from your lender. You'll probably have a couple of flat fees from your attorney. Things like, they're going to help represent you for the purchase and sale. Condo document review is something we see a lot here in the city. And then they're going to help orchestrate things like title insurance being the main fee that's dependent on the price of your home and your loan size, because they're insuring you for a specific amount. The main thing that I like to talk, the other thing that you're going to see is almost always going to see an appraisal fee, which gets paid directly to the appraiser. So a lot of times people come to lenders and be like, oh my gosh, your closing costs are outrageous. And you have to realize that there's really 1 to 2 fees that your lender charges. The rest are all estimates or are coming from your attorney, your appraiser, a number of other third-party people. So we try and, help people understand that as well. But the other thing to remember is you're also going to have what's called your prepaid expenses at closing, which means things like tax escrow deposits, insurance escrow deposits, all these things that you will eventually have to pay, but your lender helps orchestrate the payment for. So you've got things like your tax bills, which in Boston are due once a quarter, but when you have a mortgage, every month you'll make one payment for your mortgage payment and your tax payment. And then every quarter, your mortgage servicing company, whoever's taking care of your loan and taking your payments, will pay those bills for you. So one of the main emails I get from people or phone calls is panic because they get a tax bill in the mail.
That was included in my monthly payment.
Exactly, and it almost always is, unless you elect to have it not be. But the city basically shoots out those bills automatically, and the mortgage companies basically, those bills go to the homeowners and the place where they live. The mortgage servicing companies also look at their list and proactively reach out to the city for another bill. So unfortunately, those things are like 2 ships passing in the night, and it just confuses everybody. But but that's also things that you'll have to put away when you close. So a lot of people, you end up in that maybe $6,000 to $8,000 worth of closing costs, and then you've got a couple $1,000s more of tax escrows that you put away into an escrow account and things like that.
Right. Excellent. Very detailed. Appreciate it.
No problem.
Now let's talk about your company. You switched companies. This is a new company. It sounds really exciting the way that they're structured. So talk a little bit about Revolution Mortgage.
Yeah. So Revolution Mortgage is a much smaller company than the companies that I've been at before. I think there's definitely pros and cons to each, but one of the things that I have really loved about this transition has been that, the role that I took here is it gives me and my processing manager much more control over the way in which we kind of structure everything and the way in which we kind of manage our pipeline of loans. It allows us to, prioritize loans that have a very fast closing timeline. It allows us to kind of work with what we call our appraisal management company. There are a lot of rules and regulations around appraisers. Like I can't have 5 appraisers on speed dial and tell them when I need loans. We have to send it to a panel or to a company to go through a round robin, and we can't even know who the appraisers are until the report is done. But it also helps us work with the company and say, hey, look, we have a deal that has to close really fast. Another lender dropped the ball, for instance, and we have to close this in a couple weeks. Can you guys find us an appraiser that is willing to or has the availability to get this back to us very quickly, and what are they going to charge for a fee? So we can discuss with the client if they're okay with paying a higher fee to get their loan closed on time. And it's just given us a lot of ability to kind of make sure that we can get our loans from start to finish in a timely fashion, make it as easy for the client, and kind of everything else. And none of it has really been a ton of rocket science. It's really, I think, has been when you're at kind of a more boutique style company and you have direct inroads to the people that are in charge, the powers that be, and that make all the decisions, they're very willing to listen and work with branches that are, especially the ones that are doing more volume and are kind of out there as boots on the ground and seeing what's going on in the market. We can quickly change and tweak processes in terms of we literally just changed yesterday how our company reviewed the condos that we look at. Because, that whenever we lend on a condo, we also review the condo association and things like that. And the process was just a little bit clunkier than it needed to be. Mm-hmm. And because the company is so small, I was able to get on a Zoom meeting with our CEO, our COO, and the head of our condo approval review department and say, look, I know you guys don't really have a presence in Boston. We're your first presence here, and we do a lot of condos. So let's change this, and this. And they loved it. And it was so great to be able to have some say into that, which has been really, really exciting for us.
Nice.
Yeah.
So everyone's going to want to know this. I didn't want this to be about interest rates, but
Yep.
I've got to include it.
Of course.
I think the process is more important, but here we are.
Yep.
So come on now. Tell us what you think's going to happen. What's going to happen with interest rates?
I'll just get my crystal ball out here and, let you know all the interest rates and what all the scores will be in the sports world and everything too.
Perfect. Thank you.
Yeah. So unfortunately, I don't have the best news for everybody in terms of where I think the future of rates is going to be, which is I do think we are finally at this point where rates are going to start to head up, and they're probably going to stay up. Now, I say that, and hopefully people are still listening and didn't switch this off because they were so frustrated, because when I say go up, I really mean like hang out in maybe the mid 3% range.
We all need to remember it's relative.
It's so relative.
Not too long ago, 4.5 was a great interest rate.
Oh yeah, for sure. I had somebody the other day who was super annoyed that their investment property rate was 3.75, and I could not. It was very difficult to contain my frustration there because we have been very lucky in that one of the very few, maybe one of the only good things that came out of everything that happened last year with the economy being the way that it was, and everything else going on, was that interest rates were insanely low. I mean, we did a lot of loans last year in the mid to high 2% range on a 30-year fixed, no points, nothing weird. It was crazy. And now we're kind of heading back towards a little bit more of a sense of normalcy, but we're still on the lower end of it. I mean, most loans right now, 30-year fixed, good credit, everything else going on, you're probably looking in that low 3% range-ish, around 3, maybe a little under, but more likely probably a little over. There are so many things that go into determining an interest rate. And one of the things that I call out, for instance, I think it's important for viewers of probably your podcast here especially to know, is that when you're getting a loan that inevitably is ending up with Fannie Mae or Freddie Mac, which is like 98% of mortgages in the country, I believe still. When you're sending a loan to Fannie or Freddie, they actually have a small increase in their interest rate if you're buying a condominium or financing a condominium and you're doing less than 25% down. So it's a big common thing that I see where people say, well, my credit score is pristine. Everything else looks really great. Like, why is my rate not as, again, advertised online? And when you get to the fine print of that, it's, they assume a single family home, really high down payment, specific area, specific loan amount. So there are some things in there that really are potentially not entirely, quote unquote, outside of your control, unless you have an extra 5% lying around. But, in general, I think we're probably going to be in that low to mid, maybe 3% range for the foreseeable future. And I think that we'll probably hang out there for a little while, but I really can't see, even with the Fed back on September 22nd, I think it was, they kind of said, look, kids have been back in school. We haven't seen any major spikes or resurgences of the Delta variant. We're kind of going to start to let the economy work to heal itself. We're not going to continue to pump all this money into everywhere and all this stimulus. They're already raising the debt ceiling to try and, help themselves figure that out. But that was kind of their way of saying, we're going to start heading back to normal. And so we've had some people that are a little bit panicky, but when you see things on your smartphone that say rates are the lowest they've been or the highest they've been, it's probably like 1/8% difference, which is the smallest difference in interest rates out there.
Great. And what about loan volumes? How have you seen loan volumes in 2021 compared to 2020?
In terms of like individual loans or like just the volume of loans in the industry?
Loans, but both, but volume of loans in the industry.
It's still very high. 2020 was an insane year. I don't know if anybody, any other lenders are listening out there, but they're all probably nodding / shaking their heads, or I don't know, maybe even shedding a tear, because we all had a very, very busy year last year, which was, had its pros and its cons. But I think that right now we're still seeing this kind of resurgence of buyers that are coming back, that are looking to finance their purchases, because a lot of people took some time off last year, dealt with personal stuff, everything else that was going on. Some people were, furloughed from their jobs. And I think a lot of people have now become reinvigorated and are trying to continue to buy something before rates go up, and also before home prices continue to climb.
Right.
I'm sure you're seeing, prices are continuing to go up. The loan limits are going to go up again at the end of this year. Right now, a regular Fannie or Freddie conforming loan limit is about $548,250 because they love round numbers.
Right.
And 50 cents.
Yeah, exactly. 548,250. And next year it's going up to like 625. So it's going to make it a lot easier for people in higher cost areas to, get interest rates that are on the lower end. Generally, you see Fannie Mae and Freddie Mac have kind of the lowest interest rates. Fannie and Freddie in areas like Boston, which they call high cost areas, or high balance loan areas, they provision for a slightly higher loan limit there, which right now is 724,500. That's also going to increase. And then there's the jumbo loans that are above and beyond that. And, I think that the volume of loans in the industry is still high. The dollar amount per loan, the average dollar amount per loan is also going up, which is kind of contiguous with the home prices continuing to rise as well. And I think we're probably going to see that for the foreseeable future. I think that rates would have to make a pretty significant jump in order to change that, because it's still fairly inexpensive in the grand scheme of things to finance a home. But I mean, that also, I guess it also kind of depends on the rental market and things, but you probably know much more about those dynamics than I do.
Right. Well, the rental market's not inexpensive either.
No.
Everything's and that money's just going right out the window. So
True.
I don't think that's going to have too much of an impact on sales. I think the lack of inventory is our biggest problem.
Yeah.
There's plenty of people out there wanting to buy, and it's a pretty competitive situation to get them into a home.
Yeah.
And it's the coaching and the education of what they need to do in order to have a winning offer. But that's a whole, we don't need to worry about that right now.
Yeah, that's fair. None of this waiving contingencies and all that stuff.
Yeah,
that's always a fun conversation.
Yes.
Yep.
So do you see, are you seeing any particular price points that you're loaning more towards?
Yeah, so I would say we kind of tend to, honestly, we kind of run the gambit from the $200,000 or $300,000 price point all the way up to about, I would say, just under $2 million. Shockingly enough, I think once you hit that $1.75 to $2 million number, you end up getting a lot more people who either have cash or are financing it through alternative methods. Maybe they're getting loans against their assets from their bankers or their wealth management companies rather than trying to get a traditional mortgage.
Yeah.
And there's pros and cons there as well. But we do probably everything here generally tends to be in that usually around like $400,000 or $500,000 to about the 1.3 to 1.6 range, maybe. That's kind of where a lot of our stuff tends to land, which has its own, degree of complications because you get a couple different loan brackets in there with different sets of guidelines. And, especially with condos, it adds that one extra layer of fun. So keeps us on our toes, which is great.
Yeah.
I have a question. How do you see the impact, especially now, of cryptocurrency in terms of loans?
Sure.
Not a factor.
Yeah, so crypto is an interesting concept in the lending world in that lenders were very, very wary of it at first. And I think that as crypto has become more and more mainstream, I think I was reading something about there was some country, it might have been, it was either somewhere in South America or somewhere in Africa where they said more people had crypto wallets than regular wallets or like regular
Venezuela. Some country adopted it as like a form of currency for the country.
Yeah. So as these things are happening around the world, lenders are kind of getting privy to the fact that they have to get on board with it. And so at a very high level, what we're seeing now is if you have money in crypto, that's generally okay, depending on exactly how we're structuring your loan and where it's going. That's generally an okay asset to use, but a lot of lenders are wary of using that as like your reserve account. Like if you're getting a really big loan, they want to make sure you're not totally tapping yourself out. So if you sell some crypto or liquidate some crypto, however you want to put it, so that it becomes, funds that are sitting in a checking or savings account, which is what we really consider as fully liquid, it's totally fine. It's the wild fluctuations in those accounts that lenders are worried about. So once you kind of move them out of that into something that is more stable, they become really fully recognized funds. But we have seen people that have been using those for down payments in quite a few different places these days, which is kind of fascinating to watch.
It is fascinating. Yeah.
Definitely.
Yeah.
Super interested in that scene and the impact of, I don't know, like I think the Fed came out and said something about, and Bitcoin, I think it went down a little bit. It's been fluctuating, as you said, like crazy, but about regulating a little bit more, which is good and bad. I mean, at the end of the day, it would be beneficial to regulate it so we can use it in a more massive way across the country and different things like that. But that might not be good for investors because they feel as though the price will go down for it if it's going to start getting regulated.
Yeah, you see that kind of the main argument there being whether it's, is it really investing or is it speculating, because it's so, deregulated right now. And it's one of those things where, if you've got 100 people that are spouting off about it, like, or I get not even 100, if you've got Elon Musk tweeting about, whatever he's into that day, he can drive the price way up. And I think that's the sort of thing where a lot of, anything that is regulated, and mortgage lending is very highly regulated these days. It's hard for mortgage lenders to get on board with stuff that is significantly less regulated, because it kind of goes against everything that has been built into lending since 2008, 2009.
Gotcha.
But it's coming more and more every day, for sure.
Yeah.
Totally. Where can people get in touch with you if they want to reach out, they have questions, or they need somebody to help, a loan officer? What's the best place to contact you?
Yeah. So, everyone can go to my website, revolutionmortgage.com/Boston. My email is just austin@revolutionmortgage.com. I'm sure we can link some of this stuff here
Totally.
as well. And then, if people even just want to call the office line, it's just 857-557-4700. Just throw that right out there on the internet. So,
I love it.
we're never afraid to get calls and questions from people. That's kind of our all day, every day. Lisa will tell you we're pretty attached to our phones and our emails.
Yes, you are.
So, in this market, when people need stuff quickly, we can certainly help them out to get it done. So everybody can always feel free to reach out, and, I'm happy to answer any questions that people have that are, more direct to their own situation. A lot of people hear podcasts and stuff and then get on the internet, and it tends to send people in a tailspin. So
better to go to the source.
Sure.
Google's an amazing thing, but my God, you can you get a little ache and you Google what it is and you think you're dying.
Oh yeah.
So it's always best to go to someone who you can speak to, a real person, and get some real answers.
Yeah. I don't even Google any real estate stuff anymore. I just email or text my attorneys, or I've probably texted you in the past couple weeks, been like, so what do you think about this? Cause I got a client that's saying one thing and someone else that's saying another, but you're going to be my industry expert.
Yeah.
So that's what we all do.
That's great.
Yeah.
Well, this has been fantastic. I knew it would be.
Yeah.
Great to see you, and thanks for coming on.
You too.
And,
thanks for having me on.
Oh, you're welcome. And to our viewers, as we always say, we appreciate you, and thanks for tuning in. We'll see you next week.